I'm glad to be here. I'm going to run through this PowerPoint, obviously, with a new administration, lots of balls in the air. But I'm going to share with you our economic outlook for the national economy. Maybe a little bit about Chicago, although there, it's more about what's happened to the employment data. And we've got data there through November of last year. But let me, just you can see from the first page, we're in an economic recovery. It began in May. It was quite rapid in the, third quarter, and I'll show you some numbers, slowed down a bit in the fourth quarter. But as I think you can see by our title, we think economic recovery, a solid recovery, of course, as I'll show, depending a lot, of course, on the vaccines, is in store for 2021 and 2022. So here's our forecast. There's a lot of numbers there, and I'll show you some charts later. Just look at the top line. That's real GDP. The huge drop in the second quarter, 31%, rebound in the third quarter, 33%. But we're good with math. We know that going down 31% and going up 33 doesn't get you back to where you started from. And indeed, of course, in the first quarter of last year, we were down 5%. So we had those huge drops in the first half of last year, a big rebound in the third quarter. From here, we're forecasting continued economic growth. I think you can see some weakness here this quarter. We have, just barely positive GDP, obviously with the virus, contagion, hospitalizations, unfortunately fatalities, a lot of that in-person economy, recreation, entertainment, travel, retailing, restaurants, it's clearly a step back in December and so far. And, if you get 100 million people vaccinated in the next 100 days, what a blessing that would be. So we do have the economy picking up. But as my note says, this economic forecast obviously depends on the path of the pandemic, but probably more the availability and speed of vaccinations, how quickly people are going to return to, quote, a normal life, and how many are going to be willing to take the vaccinations. Obviously,
Stu, quick question.
Yeah.
That we're showing the employment time
Yes.
on the screen. Is that what you were speaking to?
Well, I don't know what's, unless I'm something else. Oh, you're maybe I'm giving you the wrong. Is that better? What are you seeing now? Are you seeing a table with data that says PNC baseline economic scenario?
Yep.
Yes.
Okay, I'm sorry. I have two screens here, and I'm only a one-handed economist. So now, fortunately, you are seeing the top line. We'll get to that other in a minute. So, not to repeat what I said, but I think you can see the weak GDP, and you can see the the kind of bolded caveats or assumptions. And as I was saying, the path of the vaccination, the willingness to people to get back to normal, how many people are willing to take the vaccinations. We had the 900 billion. I'm assuming that we will get, that the Biden administration may not get 1.9 trillion, but that they'll get a significant, maybe 1.5 to 1 3/4 trillion fiscal package in February. We also think the global economy, of course, again, depending on vaccination, China is the only country that grew last year. To the extent you can trust their numbers, they actually had growth in the second, third, and fourth quarters. We think Europe will see some growth this year. They didn't last year. That's obviously important, and they've done a lot of fiscal stimulus as well. Speaking of unemployment, as you mentioned, and we'll get to some charts in a few minutes, if you look at the line that says the unemployment rate, this quarter, we have it moving up a little, maybe 7.5 is, I hope, a little too high. The 6.9 in the fourth quarter, we did move up a little bit. There were less jobs in December. We may lose some in January. A week from tomorrow, we'll get the monthly employment report for January. We might have a second straight month of job loss, or at best a very small gain. The unemployment rate could tick up a little, but as you see, we think it, after this quarter, moves down towards the mid to maybe even low 6% range. But remember, that was 3.5, a year ago before the pandemic began. That's why some of those numbers in red show that we're still not back to where we were. If you notice, the fourth quarter of this year, we actually show the numbers in black. The print is black because that would mean finally, by the final quarter of this year, we will recapture the ground that we lost in basically all of the first half of 2020. So it takes us 6 quarters to get back where we were. So it's good, but that means 2 years of lost economic output. And so there's still a huge hole to dig out from. And, we think we're on our way, but we'd like to see it accelerate. Let me now show you a couple of charts. You're just seeing the first top line now in a chart. The big drop in the second, a little drop in the first quarter, the big increase in the third quarter, and then you can see moderate gains. We think last quarter probably ended around 3 to 4%. As I say, this quarter barely any growth, and then accelerating through the second half of the year. Again, a lot of that dependent on additional fiscal stimulus and on vaccinations spreading out. And I was just listening to Dr. Fauci and the president's news conference saying that, if things went well, maybe by the fall, we could return to something we used to consider close to normal, meaning a lot of the up close and personal activities, traveling, recreation, services, restaurants could begin to, look like it used to, or at least be on its way there. And we agree with that, kind of fingers crossed. And then as you see, we have economic growth, a little slower in the fourth quarter, but definitely a better second half of the year than the first half. I'm showing you here jobs. We had this huge rebound in jobs back in the spring, but every month you can see the increase in jobs has slowed down. And the last number there for December actually shows a loss of jobs. So if you look kind of at the headline, we lost 22.3 million jobs in 2 months, March and April. We've gained back since then about 12 million. That's through December. That's only 55%. And I got to tell you, when you look at the type of people who are still unemployed, the proportion that are women, that are people in lower income skills, that are people in the service sector, the people in education that women tend to dominate, the recovery has been anything but kind of widespread. It has really just widened the gap in income. People who have college degrees, and like us, many of us can work from home. Our unemployment rates or our job growth is almost back to where it was. But as I say, in the service sector, it is still well below, and particularly those industries in health, education, childcare, and particularly women, brown and black women. So that's what the new president talks about, is trying to have an economic recovery that reaches across our spectrum. And also that's why we still have so much, the nice word is, I guess, food insecurity, meaning people who are still in food lines and needing food because of how uneven this economic recovery has been. This just shows the unemployment rate. We got almost to 15%, but it was really 20, but it was a huge number. It's come down, as you can see in the last number for December. It actually stayed the same. As I say, maybe in January and February, not on here, it could tick up a little, but our forecast is it will be coming down to the low sixes this year, and we still have job growth and economic growth continuing in 2022. So I want to get through 2021, but hopefully we're not saying 2021 is anywhere near full recovery, or that recovery is going to end. We really do think it continues into 2022, and actually, could surprise on the high side. When you think about it, with the vaccinations, we had $900 billion. If we get another $1.5 trillion, that would equal almost the amount that was the CARES Act, the original CARES Act, in the spring of last year. That's almost 2.5 trillion. Now it's all deficit finance, so I'm sure we'll talk about that later. But by the way, we have just under a $20 trillion economy. So you're talking about fiscal stimulus that would average about 12% of the economy. So that's why I think there's some upside potential to our economic forecast, and hopefully even some downside to our unemployment rate forecast over the next 12 to 18 months, especially not only in the US, but globally as vaccinations become more widespread. I'm going to look at this chart. This is called a diffusion index. This one refers to the manufacturing sector, which is a little over 20% of our economy in terms of output. It's only about 12% in terms of jobs. But I think it shows, very importantly, how good manufacturing has come back. When you're above 50, you're in plus territory. So even before the pandemic, late last year, this index was floating around 50. Of course, it crashed in April and May down into the low 40s. But look at the rebound that we've had, and even the last number in December, despite the spread of the virus and the effect it's had on the service sector, the manufacturing sector has done very well. Now, a lot of that is autos and trucks, both light and heavy. We're also seeing in the last 3 or 4 months, finally, Boeing actually starting to get some orders and produce airplanes, although after a near collapse with the 737 MAX flying again. And in the non-durable side, you can imagine oil prices are up, so we're seeing an increase in petroleum. But of course, all the essential items, the food, the beverages, a lot of those items, which are manufactured goods, are which got this thing up to where it is. And we think manufacturing, we got a little bit of data actually so far in January from some of the regions. This is a national average. We got some from Chicago. Chicago always comes out. We won't get that till next week. But we got something from Philly. We got something from Richmond. We got something from New York. So more East Coast. But I was surprised that the data that actually show an increase so far in early January in some of these indices. We'll see if that happens in Chicago, because admittedly, you guys, the Chicago Purchasing Managers Index, I won't say dominates, but it makes up a large share of this. And we'll see if we get a little bit of an increase in that next week, because it was down in December. So we'll see from there. But that's manufacturing. If we go on, here's what's called non-manufacturing. Now, non-manufacturing would include, of course, all the service industries, that we're familiar with, the high tech and professional business, but obviously airlines, recreation, cruise, eating out, restaurants, that's all in here. Also, what's in here is some mining, which has not done very well. Now you're seeing a little bit of improvement in the mining, oil and gas sector as oil prices have come up in the last 4 or 5 months. But you see we're well back above 50, and you see where it collapsed back in April and May. But, compared to the chart before, it's been more of a flat. We've been going up and down around 57, 58. So it's good to be above 50, but you don't see the momentum. And I think clearly that's because the increases in cases and the shutdowns of a lot of service industries or partial shutdowns is what's happened. And I wouldn't be surprised if that number comes out for January, flat to down a little more, even if the manufacturing. So this is about 75% of the economy. So in terms of its weight, this is a much bigger weight on that GDP overall, and certainly on jobs. So manufacturing is doing well, but in here, this is non-manufacturing. The one thing that's in here, though, and that is doing extremely well, and I'll show you, is housing. Not non-residential construction, but housing is gangbusters. And just this morning, we got a housing starts number that, this would be, I guess, for December, that blew away all the estimates on the upside. So housing's doing very well, and I'll point that out to you in a few minutes. Here it is. These are home sales. What came out this morning was starts, but you're not going to start them if you don't sell them. And I think you can see these are new and existing. Now, we sell about 5 existing homes or resales for every sort of new one. And you did see a little fall off. The blue line is new home sales. late last year. This week, we're going to get more data. I wouldn't be surprised if you saw that number rebound, particularly that new homes, maybe even get revised up. Mortgage applications to buy homes has been going straight up in the first couple of weeks of January. Obviously, around the holidays, that those fall off, but they've been coming back. We have data through about the middle of January. They'll both refi, but particularly to buy a new home, what are called purchase applications, have gone way back up. And that's usually a sign that home sales are doing well. And I expect this spring, summer, the heart of the home buying season, when areas like Chicago and Pittsburgh and New England and, the Northwest start thinking about spring, and we actually have one. I think these numbers haven't reached their peaks yet, and are going to go higher. So housing, well, it's only around 4 or 5% of the economy. The effect it has on purchases we buy for our home, the home remodeling, which isn't directly included in here. Housing, in addition to manufacturing, is what's holding the economy in. And if we're right, or Dr. Fauci or other scientists are right, that by summer or by fall, we actually are beginning to reach some herd immunity, then you can get that service sector, and maybe with some higher energy prices globally, even our important energy sector to kick in. That's where some of that back half economic growth and into 2022 comes from. This just shows, not surprisingly, home prices. Home prices were going about 3-4% a year. The pandemic hit, and home prices have taken off. Mortgage rates, of course, are under 3%. 2.75%, the lowest in our lifetimes. Work from home has meant many of us think about, where we're living, how big it is. Is it suburban? Is it urban? And the amount of new homes and building and existing homes on the market, that supply and inventory is way off. So not surprising, when demand's going up and supply is going down, prices go up. And I think you can see, and that's also been the case in Chicago. We only have data through Chicago, not as recent as this, but you see a similar, I don't have a chart for you, but you see a similar pattern as well. And another thing happening here is millennials. Millennials are coming of age. They are marrying, they are having families. A lot of millennials have the skills that have kept them at work from wherever they're working. So the millennial generation kind of reaching some prime age, having families, finally moving out of their parents' basements or getting kicked out, either way, is part of this. So the demographics, in addition to the low interest rates, and of course the kind of new regime that probably even lasts beyond the pandemic of work from home.
Stu, we had a question about the real estate.
Yeah. You want to do it now, or you want to? I got about 5 more minutes, and then we can turn to Q&A.
Okay, go ahead.
Okay, let's. Yeah, I figure we're going to talk a lot about this. This is kind of a complicated chart. I don't want to belabor it, but this gets you to the Fed. The Federal Reserve back in the spring were saviors. Powell and his colleagues at the Fed, cut interest rates to zero. Did all those special programs, supported the market. They did so many things, and I think it was absolutely crucial. And they probably did it faster and more adroitly than they did back in 08 or 09 in the midst of the great financial crisis. Then, of course, you got the fiscal stimulus, just the opposite of what happened, frankly, in the early 30s. In the early 30s, Hoover tried to balance the budget, and frankly, the Federal Reserve basically tightened monetary policy. I don't want to even think about what the economy would have looked like in the last 6 months if we had made that mistake almost a century later. We didn't. So this shows you the Fed has a target of inflation of 2%. That's that green horizontal line. The orange and blue lines are what inflation's been doing. I show you back to 2012 because that's when the Fed officially adopted that 2% inflation. I think you can see, other than maybe in late 2018, they never got there, and they're well below it now. That's why back in September, actually late August, the Fed adopted what it called this, in my title, flexible average inflation target. a mouthful of saying, look, we've been under 2% for so long. We actually like to get inflation above 2%. Now, they don't give me an exact target. They say moderately above, but I interpret that as around 2.5%, at least for the next couple of years. So here we are, well below 2, yet they'd like to even get it higher. It will go higher because in the next 6 months, because prices fell, last February, March, and April in the midst of the beginning of the pandemic. You can imagine prices fell for just about everything, but particularly services, even to the extent that you could go to a sporting event or you couldn't, what was a Broadway ticket if your Broadway's dark. So they will get some acceleration, but I can tell you the Fed is going to be on pedal to the metal monetary policy in addition to fiscal policy for at least the next couple of years. They've been buying so-called quantitative easing, 120 billion a month. The market's been a little nervous that they might taper that. They're not going to taper that this year. Maybe by next year if we get some of this economic growth. But the Fed's not going to do anything to try to slow down the economy or slow down inflation. They want faster inflation. And obviously, if you hear Chairman Powell talk, they want faster economic growth. And Yellen, as the Treasury Secretary, and hopefully she'll be voted on any day now, is an excellent choice. I think Biden's made a lot of very good choices. Cecilia Rouse to head the CEA, and Yellen to head Treasury. And Yellen will work so well with Powell. I think that is, at least a sort of marriage, an economic marriage made in heaven. Now, by the way, Powell's term expires about a year from now. So Biden will have to decide who's going to be Fed chair. And, it's too early to speculate whether he'll keep Powell. I think he may well. Lyle Brainerd, who's a governor who was talked about as possible Treasury Secretary, is certainly somebody that could be considered to replace Powell a year from now. But I think the good news is the Fed is in great hands. Whether it's Powell or whether it's somebody else, I don't think the policies are going to be that much different over the next 2-3 years, and especially with Yellen working so closely with the Federal Reserve once in her new position, which I'm sure she'll get appointed to. This just shows you our interest rate forecast. You can see the I guess what do you call it, brown line at the bottom. That shows we don't expect the Fed to raise rates next year. If I extended this out into 2022, it would still be a flat line. Now, I can tell you, if you went to your cardiologist, and I just had an appointment with my cardiologist, and he showed you a flat line, that would not be a good EKG. That would probably say, good luck, you're out of here, and we'll take you on a gurney. But for interest rates being flat for another couple of years, that's good. Now, we think 10-year rates and mortgage rates may move up a little bit. You can see the blue and green line, a little spread, which actually bankers are like. But as a borrower, to think about interest rates near zero for at least another 2 years, and even a 10-year rate moving up towards 1.5, you can see before the financial crisis, it collapsed. Or before the pandemic, it collapsed. And, a couple of years ago, it was 3%. I don't think it's going much above 1.5 or 2% anytime in the next couple of years. So that is a very, I think, positive interest rate backdrop for the economy to complement, frankly, the fiscal policy that we need to really get us out of the pandemic, along, of course, with science. Final chart and a few comments on the stock market. This is the close. It's really way out of date because it was the close as of yesterday, although it's really not that out of date. I think we were up a point today on the S&P 500, and I focus on that rather than the Dow. So we're at 38.55, a new record. Obviously, you can see the collapse back in the spring, and you can see the rally. I got to tell you, I'm pretty positive, and PNC is pretty constructive on the stock market looking forward. For right about the economy, we're going to see much better earnings growth. Yes, the market is not cheap. It's, at over 20 times trailing earnings. But trailing earnings include the pandemic. as we get into 2021, we could see earnings growth for the S&P at close to $200. So, times 20, that's 4,000 on the S&P. And so our view on the stock market is it's going higher. We think we are going to break 4,000, in the first half of this year, probably end the year higher than that. So if we get some sell-offs, we would kind of, view that as probably a buying opportunity. And when you compare that to short-term interest rates near zero and, term rates, 5-10 year rates, as you saw, moving up a little bit, not a lot, but, maybe moving up a little bit here, the 10-year treasury rate, rate of return in the bond market this year is going to be pretty flat, and short-term rates are going to be pretty flat, no price risk. That makes stocks, even if they're up 5, 6, 7%, and we think they will be, pretty darn attractive. So I'm gonna finish with my little kind of list of what I think looks good for the economy and what I think actually looks pretty good for the market. And this list is vaccinations, reflation, speculation, was maybe a little bit too much with Bitcoin, valuation, stimulation, and this is also global, dollar depreciation. And by the way, I didn't mention, of course, we saw in England, they did a deal, Brexit. There was no hard Brexit. So we had Brexitations. And I think you put that all together, and with apologies to the Beach Boys, vaccination, reflation, speculation, valuation, stimulation, dollar depreciation, Brexitation equals good vibrations for the U.S. economy, and I think for the stock market in the year or so ahead. And I think actually it might be heresy to say having the Democrats control the House and the Senate, the so-called blue wave, maybe light blue, isn't such a bad thing. And to be honest, if they raise upper income rates, tax rates, you're going to have to do a little something to try to pay for a lot of this fiscal spending. So, we don't add endlessly to the budget deficit and the debt. And if they raise corporate rates a little bit, or they raise the minimum wage a little bit, forgive me, I don't want to get drummed out of the economic profession. But I honestly think, again, given the tremendous dichotomy in this recovery and the tremendous debt that we're doing right now and need to do to deal with this, maybe if we have to see, and if we're going to do an infrastructure project, maybe a little higher tax rates, maybe a little higher corporate and individual rates isn't such a bad idea strategically if you think over the next 3, 4, 5 years, and admittedly trying to deal with this huge budget deficit. So that's my spiel. It's a little past the half hour. I know you have a lot of good questions, so I'm gonna stop my comments there. And you said there's a question about real estate and others. So Dan, if you want to kind of look through the list and give me some questions, and anybody else keep putting them on the chat, and we'll spend the next 20, 25 minutes answering your questions as best I can. So thank you. Hope everyone's well, and I'm counting on being together with you next year. And Dan promised he's gonna actually buy me a drink.
Amen to that. So,
but he'll charge. Don't worry, he'll charge it to PNC.
Before we start, Stu, do you want to unshare your screen and I'll put
Yes.
Dan on video with you?
Yes, I will. Got it.
Thank you.
Great. So one question, Stu, was about the increase in the housing market, the purchases. Yep. Is that coming directly at the expense of housing rentals from the rental market?
It doesn't look that way. Obviously, have a lot of people. That's another issue about, the people getting evicted or not being able to make rent. And certainly one of the executive orders that President Biden has signed extended the moratorium on evictions, also some executive order on student loans. So what we're seeing is there's no question that rental inflation, or the rise, not in the home prices, but in rent, has slowed a lot, even as home prices have gone up. And rent, by the way, is about 30% of the CPI. Now, some of that rent also includes kids going to college and staying in dorms. Well, they're not too happy about, the parents are not too happy about paying a dorm rent when their kid, is annoying the hell out of them stuck in the basement. So that's been a factor. Obviously, a lot of the people who, a disproportionate number of people rent that have lost their jobs. So that's been a slowdown on rent. So I don't know, as I'd say it's coming at the expense of the rental market, but I'd add maybe a question that you didn't ask, that there is a big difference between residential and non-residential. Housing is strong as heck, but office buildings, PNC built a beautiful building 5 years ago. We grew into it, or we're hoping to, in downtown Pittsburgh, and we have others. It's going to be a while until many of us are back in the office, and I'm sure that's true for you. So does anyone want to build a big office building somewhere? Do we need that? Does anyone want to build a hotel or a motel? You'd just be happy to get occupancy back up to over 50%. Does anybody want to build a mall? Maybe we'll go back to malls for a little while, but we're still going to do a lot of our shopping online. I mean, we were doing that before the pandemic, and it only hastened it. Governments. Now, if we do get this fiscal stimulus package, there's money in it for state and local governments that was not in it for the $900 billion. So what you've seen is state and local government spending on roads and infrastructure has gone nowhere, if anything, gone down in the last 6 or 7 months. So public construction is down. Private construction is down. There's some industrial that's going up because I said manufacturing is doing better. And if we do see that we're going to do, more mandates to have medical products and other things manufactured here, given the problems we had, that we didn't have enough of cotton swabs or medical equipment or ventilators. So we might see more of that, kind of come back on shore. But outside of industrial manufacturing, there's really not been anything going on in real estate. And, PNC is still, and many other banks have, increased their reserve allowances for possible defaults. Now, it hasn't been that bad so far, but I think a lot of property just hasn't been put on the market. It's sort of like waiting there to see what happens. But I imagine if you try to sell an office building in New York, or you try to sell a big hotel somewhere, you might be scrounging around for some bids. You got the ask side, but I'm not sure what the buy side. So residential looks very good. And I think it'll be a great couple of years. But non-residential, which by the way, is probably a little bigger when you include public, not looking as good. But if state and local governments do get some money, some, of course, from a job perspective to keep their essential workers, their teachers, their security, their law enforcement, so they can keep them on the job, because state and local government jobs have gone down. They have not turned around the last couple of months, even though private sector, as you saw, jobs have gone up and quite a bit initially. There's still fewer people working today. Forget the federal government. There's still fewer people working today in state and local governments than there were, say, back in February. And that's because their budgets have been squeezed. So they've had to lay people off. So maybe if we get them some money, not only, of course, to help with vaccinations, but basically to help them keep some of their essential workforce and their teachers on the job, that will be a help. But without some sort of a big infrastructure plan, and maybe Biden's going to announce that, you're not going to see much out of non-residential, private or public construction, other than, of course, warehouses for Amazon and a few other places that they keep building warehouses so that, they can have that global and certainly domestic distribution. That was a long answer to a question about residential, but I also try to get non-residential in there as well.
Yeah, on that office market, do you expect that to be a number of years to work through that?
Yes.
Yeah,
I think it's years. I think it's a number of years to work through that. The office, the hotel, motel. I mean, you could spend the first half of this decade kind of working through that, even hopefully well past the pandemic. And certainly the retail side, I'm not sure you're going to need many new malls in this country, or retail strip malls, or big malls anytime, even in the next 5 years or longer. By the way, one thing I want to mention to you, because I forgot to mention the Chicago numbers when I talked about the employment report, that about 55% of the job growth that was lost. The numbers are very similar in Chicago. The unemployment rate there went up, very similar to the national trend, just a little over 15% at its peak. It's down now. It's a little higher than the national number. I think it's in the 7s. The national number is in the high 6s. But not surprisingly, a little over half of the jobs lost in Chicago, the Chicagoland, the Chicago metro area. So very similar to the national trend. You've done a little better in manufacturing. You've actually lost fewer jobs and gained more, and that speaks to what I talked about manufacturing. But certainly your tourism and entertainment and travel and industry, which is obviously important to Chicago, like New York, has been very hard hit. So you've done better in manufacturing. You've probably done a little worse in service sector, but kind of overall, you've had a national experience, a terrible drop in jobs, a recovery, but as we say, a little better than 1 out of 2 jobs, which is certainly good, but nowhere near good enough.
On the manufacturing side, I think you called that chart the diffusion index?
Yes.
Why is it called that, was one of the questions.
A diffusion index is a survey that's done where you simply ask, you go to people and say, I'm going to ask you one simple question. They ask them more, but the answers are either better, the same, or worse. That's why you got 3 choices. You have more people working for you compared to last month? More, the same, or less? Were your orders higher, the same, or lower? That's referred to as a diffusion index. So if it's 50, that's basically saying about as many are saying it's up as down, or the majority is saying it's unchanged. That's kind of like the break-even level. So it's a diffusion index. It's just a term we refer to when you're asked a survey and you can say higher, the same, or lower. But the other implication of that is, even though those numbers are quite strong, that number for December that went up to over 60, the question asked is, how is December compared to November? Not compared to December a year ago, certainly not compared to last April. So what they're saying is, compared to the month before, month by month, and that's why you saw such a big jump back in, say, June, because that was being compared to May. But the fact that numbers continue to rise is a solid gain in manufacturing month over month over month. The fact that the service sector had the big rise in the summer, but it sort of plateaued, is a sign that because of the spread of the virus, because of the lockdown or shutdowns, to going to restaurants are open, then you can't, or those things, is what stalled out the momentum in that particular index. So I don't want to get too wonky on you here, but that's what a diffusion index is. It's changes relative to the last month. If you're over 50, more are saying good things are up. If you're under 50, more are saying down. And the good news is it's above 50 for both indexes. The better news for manufacturing is it's kept moving higher, hasn't plateaued. And that's probably more than you ever wanted to know about a diffusion index. Now, an infusion index is much different. That's where you get a bottle of wine and you pour that and you drink it. That's infusion. Or you could do bleach, or you could take bleach and drink that, but we don't have to go back there anymore.
We'll go to the wine next year on the infusion index.
On the infusion index, that'll be next year.
So with all the stimulus coming on, I think we hit upon it a little bit, but the impact to the dollar, can you talk?
Yeah. I'm glad you asked that, because I didn't say a lot about the global economy. I was somewhat remiss. I mentioned, of course, Brexit, although Europe looks like it actually, GDP fell in the 4th quarter. Certainly in the UK, maybe Europe was flat. UK went so-called double dip recession, meaning they had a rebound in the 3rd quarter, but with the variant strain and the increase in cases and fatalities, the UK economy actually fell back into recession in November, December. The rest of Europe, the continent, wasn't quite as bad as the UK, but the European economy, flattened out in the fourth quarter, and maybe we'll be down this quarter, even if we're sort of a slight positive, mainly because of the fiscal stimulus. You're not seeing as much of it in Europe, but you have seen the ECB, the Bank of Japan, for that matter, the Bank of Canada, the Bank of Australia. What I told you about the Fed is pretty much gone on everywhere, including the Bank of China. All those central banks are doing QE. The European it's called PEPP, which is something about pandemic emergency plan or something like that. They're doing quantitative easing, and they have negative rates. I mean, Germany has negative rates. And I'll get to the dollar because that's important. France nearly has negative rates. The UK hasn't gone negative, but I'll tell you, it's not out of the question, although their rates are a lot lower. Well, their short rates aren't lower than ours. They're zero, but their 10-year rates are lower than ours. By the way, the 10-year rate in Germany is minus 50 basis points. In the US, it's today about 1.1%. So Europe is weaker. As they say, China, they left us all behind. They are growing again. They're doing well. Other parts of Asia are doing somewhat better. Taiwan, Thailand, Vietnam, they've done better in terms of controlling the virus and come back. But South America is still, weak. Obviously, North America, Canada's had some problems as well. Mexico. So, it's, the global economy has certainly been, it's a global recession. And clearly we all went down together. We've come up at different paces depending upon how the virus and the vaccines have improved. I just read, I forgot who it was, they just approved the Russian vaccine. So one of the other countries. If you're not interested in getting the Pfizer vaccine or the Moderna, you can easily get the Russian vaccine. It's available to everybody. It comes in a vodka bottle. You drink it all down and you will not feel anything. You'll be fine. So if you want the Russian vaccine, that's readily available at any liquor store you want. But if you want the Moderna or you want COVID, or you want, hopefully Johnson & Johnson's going to be out soon too and may get approved. So there are going to be a lot of choices. But as they say, the global economy. Now, when you get to the dollar, the dollar has been weaker. And in one of my little, rhymes, I did have dollar depreciation. So the dollar has gone down. The euro's back to about, what is it now? About 122. It was down around 115. The Canadian dollar was around $1.33 Canadian per US. Now it's about $1.28. The pound was down to about 112, 113. Now it's, or maybe not quite, maybe 120. Now it's up to 135, meaning $1.35 to get a pound, particularly with the Brexit deal. So the dollar has been weaker. Maybe not so much against the Mexican peso. It's gotten weaker against the Chinese renminbi. For a while, I think it was 8 renminbi per dollar. Now it's 7.5. So the dollar has weakened. And we do think the dollar will continue to weaken, but I'm not looking for any big collapse in the dollar. I'm not looking for the dollar to be replaced as the world's reserve currency by the euro or the renminbi or even a basket. So some people say, hey, the dollar it's down for the count and it's going to get knocked out. No, the dollar is probably going to continue to weaken. That's some of the reason that earnings will be better, particularly for international company and multinational company. It's why some of the emerging market companies countries might do a little better because they're a little bit of a tailwind for them when they have a weaker dollar. So if you told me that the dollar got up to $1.25 against the euro, wouldn't surprise me. If we got to 140 against the pound, if we got down to $1.25 Canadian for a dollar, if we got down to near parity, the yen, forgot to mention that it's down to about 103 or 104 yen per dollar. So a little better than a cent. I wouldn't be surprised to see the yen go to 100 to a dollar, meaning the yen basically is worth a penny. But not that long ago, it was about $1.10. So the yen was worth less than a penny. So whether it's the yen, whether it's the euro, whether it's the Chinese, whether it's the Canadian, maybe not the Mexican or the Indian rupiah, some of the developed markets, but even there, the dollar has been weaker. So my way long-winded answer is I think the dollar will get lower. I think the dollar index that I look at is in the low 90s. It was closer to a high 90s, so it's already down around 5-6% in the last, say, 6 months. I wouldn't be surprised if that headed down into the mid 80s, which is another 4 or 5%. It won't be against all currencies, but yes, I think the dollar depreciation, which has been occurring, will continue, but in an orderly sort of 2-step down, 1-step up fashion. But 6 months from now, I expect the dollar index, and against most of those major currencies, the dollar will be 2, 3, 4% weaker than it is today. And today it's 4 or 5% weaker than it was 5 months ago.
Good. So another question that popped up was, with all the stimulus and trillions of dollars thrown around, where do we really get concerned with the deficits we're running?
Yeah, that is the question, and I don't know the answer. I do know that because of the depth of the recession and because of the disparity of the recovery, that it frankly already started even before the pandemic with a growing disparity between the haves and the have-nots. And I think we saw a week ago or 2 weeks ago, Wednesday, a little bit of that expressed in the violence in the Capitol. That I don't know when enough is enough. I do know, though, that if you're going to borrow money, if the Treasury is going to borrow money, and Yellen certainly suggested that, the time to do it is when you have the lowest Treasury interest rates we've had in any of our lifetimes. They've never, maybe in the Depression, but in any non-Depression time or any non-war like World War II, when, of course, they were being held down. If you're going to borrow 10-year money or 30-year money, borrowing it at 1.1% for 10 years or 1.75 for 30 years, and Yellen even hinted about maybe a 50-year bond. She didn't say exact. She said an even longer bond. And why not? If you can borrow money for the next 50 years from the Treasury and pay a little over 2%, which is what you used to pay for 3 months to borrow for 50 years, why not? That's also a reason why I don't think the dollar will get crushed, because our interest rates are going to be higher than in Europe, where a lot of rates are negative, and that gives some stability to the dollar. But it also says if you're going to borrow money, if the Treasury is going to borrow money for infrastructure or to fund the fiscal stimulus, and they certainly did since last spring, the fund, that's why I had a $3 trillion deficit. I don't know where too much of a good thing is too much of a good thing, but at least for the next couple of years, if I'm right, we'll finally get the economy by the end of this year back to where it was 2 years earlier. That's a Grand Canyon of an economic hole that was dug by this pandemic. If you can grow 3-4 years after that, growth is the best way to get the deficit down, because it means you don't have to have more fiscal stimulus. You do have more tax revenues as companies and individuals earn more money. So we're not going to cut Social Security. So frankly, the best way to get the deficit down over the next 3 to 5 years, I'll call that strategic, not the next 20, is for the economy to grow 4 to 5% a year and grow out of the hole and then catch up for what was lost, so that 5 years from now, the debt's still high, but the deficit isn't ballooning. That's probably the best way to deal with what admittedly is a debt that is very uncomfortably high and is going to get higher in the foreseeable future. But I don't know where, the breaking point is.
Right. We're winding up here, but we had number of questions around cryptocurrencies and
Okay.
from an economist perspective, what are your thoughts there?
Yeah, I don't know as I'd have a lot to add. Certainly PNC from an investment portfolio. I mentioned to you earlier, we like the stock market. We've been kind of 2/3 equities, 1/3 fixed income for I don't know how many years. It seems like forever. We haven't changed that. We haven't gone 70-30, but we haven't added gold. We haven't added cryptocurrencies. Maybe we will. If you want to do it on your own, PNC. So I thought they were a bubble when Bitcoin was 10,000. Now it's what, 30,000, and it's down 10,000. So I don't know what a bubble is. I guess as long as people can open up Robinhood accounts, and as long as they can take their stimulus checks, which I think we're hearing a number of our younger, less experienced, but I suppose wiser millennials are doing with their money, and they're going to get 600 and maybe another 1,400. And as long as they want to throw it into Robinhood and buy Tesla and buy Bitcoin or buy, what's the other one, Ripple or something like that. In our day, Ripple was a cheap wine. Now it's a very expensive cryptocurrency. So I wouldn't offer I wouldn't offer anybody any advice on cryptocurrencies other than to admit 2 or 3 years ago, they were considered an accident waiting to happen. And since that accident waiting to happen, they've gone up 4 or 5-fold and are double the previous peak a couple of years ago. So I'll leave it at that. I can tell you, I don't have any Bitcoin personally, although I've been tempted, but it's the bigger fool theory. I figure if I can buy Bitcoin at 30,000 and sell it to some stupid millennial who hopefully isn't my kid or grandkid for 50,000, screw them. I'll take their money and run, but I haven't done it yet.
Well, thanks very much. We appreciate all the insights, and thanks again for joining us again.